We talk about multi-baggers in stocks. There have been many 100-baggers in mutual funds too.
What is your take on sectoral funds?
I'm worried. Stupidity, greed and fear are three reasons why most people will never be able to create wealth. That was the reason why I wanted to be that one idiot and say, किसी दिन मैं 100 crores मैंने सारा बनाया through mutual funds. Now most people seeing this podcast may be wondering कि आज all time high है. He's saying to put everything today. In 4 years I invested around 37 odd lakh in a PSU fund. It became 94 lakhs in 4 years.
When I go and open up any portal, there are tens of categories of mutual fund. So how do you navigate and what is the right framework or right approach to build a mutual fund portfolio? Hello and welcome to Power Academy. Today we have with us someone who has built more than 50 crores of wealth using mutual funds alone. Meet Gajendra, the co-founder of Etica Wealth that manages over 2,000 crore of AUM and has nearly 2 decades of experience in markets, making him the perfect guest to talk about mutual funds today. By the end of this video, we will learn about 1. The top mistakes to avoid while investing in mutual funds. 2. SIP or lump sum, what's the better strategy? 3. How to build your own mutual fund portfolio using different mutual fund categories. 4. Why are index funds the best way to enter into equity? 5. Thematic and sectoral, are they good for you? And last, Gajendra's own portfolio that helped him build more than 50 crores of wealth. That being said, let's get started. Hi Gajendra, welcome to Power Academy. Thank you so much for taking out the time. When we decided to, do an in-depth video series, I think it was a no-brainer that let's do it on mutual funds because that's the key to wealth creation in long term.
Absolutely.
And then who better to talk about mutual funds than you who, started his journey from like 10,000 SIP to now doing 30 lakh plus SIP between you and your brother.
Yes.
And having a 50 crore plus portfolio. So I think let's get started right away. We'll delve into your insights, your personal journey on mutual fund and how the industry is being shaping.
Absolutely.
So let's get started.
Absolutely.
Yeah.
Thanks, Navda. So my brush with mutual funds started way back in 2004. That time, when I joined this industry, before that I didn't know anything about mutual funds. Even after spending first 6 years, Navda, in UTI from 2004 to 2010, I knew the theoretical stuff, but it didn't get into my head, that this is such a powerful vehicle. Only back in 2010 when I started my SIP of 10,000. And the result of which actually started seeing after 2020-21. So it actually takes 10 years for you to see meaningful outcome from your investments, right? So that is when it stuck to me that, wow, I have really, struck gold now. We talk about multi-baggers in stocks. There have been many 100-baggers in mutual funds too. Which means if you have invested like a lakh rupees, 25 years later, you are sitting on a crore rupees.
Wow.
Right? And it's a diversified set of a portfolio. So to me, what excites me most about mutual funds? It is very safe. Now, many people think mutual funds is equities. Equities means risk. Yes, of course, equities means risky thing. But when you invest in a single stock or a couple of stocks, and if your selection is not very right and you end up investing in a very BC category of stocks, you may end up losing money. But in mutual funds, when you're investing 50 stocks, 60 stocks, the fund manager invests on your behalf.
Right.
And remember that this is run by a professional fund manager. So
Yes.
they are not going to really put in Dutch stocks, right? So you will never end up losing permanent capital. And one more thing, Navda, is that in India, the mutual fund track record is for 30 years. So you can always go back in history and check how the funds have delivered. Plus, not just in India, in US, the history is more than 100 years old.
Right.
And this is a worldwide phenomenon now. So, and in our country, the regulator is superb. SEBI, which many of our viewers may not know, they're doing an excellent job, which means they are actually working hard to make sure that you can sleep peacefully at night.
Yeah.
Right? So, all these things make a perfect recipe for a common person in India. Someone who has just 500 bucks can start putting money in mutual funds. Even an auto rickshaw driver, Uber driver, or anybody.
Yeah. No, absolutely.
Can put in and can forget for long term. And one fine day when he opens, I think it will be, pot of gold he'll strike. I've realized that in India or world, when it comes to stock, this thing, you talk about Warren Buffett, you talk about Charlie Munger. In India, we talk about Rakesh Jhunjhunwala, Ramdev Agarwal. But if I were to ask you, have you met someone who has created reasonable amount of wealth through mutual funds?
Handful.
There's no prominent
Yeah,
name.
very handful.
The frame I always say is empty.
Yeah.
That was the reason why I wanted to be that one idiot and say कि किसी दिन मैं 100 crores मैंने सारा बनाया through mutual funds.
Yeah.
And अगर मैं बना सकता हूँ, which means a common person by putting this, anybody can else put it, which means it's not a rocket science. I don't have a secret sauce.
Yeah.
In this, you don't have to be lucky to create wealth.
Yeah.
You
no,
just
very
follow a
rightly.
few things, principles, and you will also become one idiot.
Yeah, no, absolutely. I think just the right note where we wanted to start this podcast. One thing that we observe, and the trend is also showing that AUM usually follows the return. So I think that's what the equity mindset is. जो भाग रहा है उसमें पैसे डाल लो. What are the top mistakes that you have seen in your clients or in your personal journey as well
Yes.
with respect to mutual fund investing?
100%. It's very, very, very interesting topic, and I'm sure it's very relevant in today's context. So there used to be a fund manager called Peter Lynch. He has run one of the most successful fund in the history of mutual funds in US called Fidelity Magellan Fund, which for good 11, 12, 15-year period has given 20% plus compounded returns,
Oh wow.
which in US was crazy, right? So he always used to say that my fund has given returns, but my investors have never made returns.
Oh, how?
Because whenever his fund was doing top of the charts, a lot of money would chase the performance and he would
Okay.
get far higher AUM. And when his fund was not performing in between, all the money would go out. So the money came in at the wrong time, the money went out at the wrong time. Right? Net in the long term, funds gave good returns, but none of the investors made.
Ah.
They never stick to their philosophy. So what mistakes people make? Generally in good cycle, people become very greedy. See, I'll tell you, Albert Einstein used to say the whole world is full of people of three kinds. There are stupid people, greed and fear. Stupidity, greed and fear are three reasons why most people will never be able to create wealth. So I have a guru by the name Nick Murray.
Okay.
He's based in US and he's 82 years old. He has a very favorite line. He says, human nature is a failed investor. Okay? Humans on their own will not be able to create wealth unless they are advised in a right way. Because
Our
of
own
our
biases,
emotions,
yeah.
our own biases,
Yeah.
emotions play. See, when your hard-earned money is at stake, and the way you said, if my 100 becomes 90, I'll not get peaceful night of sleep. So the moment you see 90, you would like to do some action. You can't just sit and see your money going down. And that is what is the problem with money and with creating wealth, because any action that you do, and if it is not a right decision, you're going to further sink down. Greed, fear, stupidity, these three things make people nervous at the wrong time, and that is why they are not able to create wealth. Right now we are living in euphoric times. I have seen my
absolutely.
investors' portfolios, they were happy with 12% return. Today when they're seeing 18% return also, they're saying Gajendra maza nahi aa raha. Can you give me
Greed.
25%? Greed.
Yeah.
And we know that this is bound to happen. This is not the first time we are seeing this cycles. There are plenty of examples that people have lost money due to this greed. So the biggest reason is greed and fear. The second reason that we are now seeing is FOMO factor, fear of missing out. The wealth is also relative. You have to understand. If you are making 15% return, that's a classic, a good one,
Yeah.
right? But if your friends are making 20% returns, how can you stay quiet? You need to kind of topple them, na? That is becoming a big problem. So people now are checking their portfolios and comparing with their peer groups, and if they are seeing that their portfolios aren't doing well, they want to change it. So that's again becoming a second worry. Third is people now want instant results.
Yeah.
They don't want to wait for 4, 5, 7 years. They want to see in 2 months, 3 months, 6 months. And that is why, like PSUs, we saw defense, all these things, a lot of money is coming to this sector,
Yeah.
this space. I always ask people, what is finance 101? The number one rule in investing: buy low, sell high. What do people do? They do the
Buy
reverse. They buy high, they sell low. People wanted to sell in pandemic and they are right now queuing up to buy. So it's against human nature. Now, if there is a sale in Kormangla or Indranagar, suppose there is a 30% sale, maybe you're going to buy one dress. If I say that sale is now 50%, you'll buy 2.
Yeah. Even though I might not need it.
You will not. I know. I knew. And if I say the sale is 80%, you'll buy 5 others, 5 more.
Yeah.
Maybe you'll give to other
True.
people.
I don't do that when markets do that though.
Exactly.
Yeah.
Why don't people do the same when markets are, giving this opportunity? The best of companies, the best of, funds are available at 50-70% discount. Why don't people buy? And, mind you, this was true 1,000 years before. This is true today. And I think this is going to be true even 500 years from now. Because when you see your 100 rupees becoming 50, 70, your mind stops. You freeze. You are not able to think rationally.
Yeah.
And that is why some people like us professionals who have seen multiple cycles, right, can tell you and saying that, look, this has happened before and this is happening now. Don't worry. Just stay put. You're going to make money. In fact, if you have more money, put in right now when the markets are down. So once you've tasted this, once you've understood this, if you've gone through one cycle and you've learned from the mistakes, then I hope you're not going to repeat the same mistake in the next cycle.
Right.
But most people are yet to see this happening.
Yeah. No, I think you spoke about, if the market is low, go invest even more,
Yes.
to take advantage.
Which is what I did
in the
March
COVID.
2020. See, I'll give you my timeline. 2004, the first day of my career in Bombay, May 17, 2004. मैं ऑफिस आया. That day markets fell 17%.
Oh.
Because NDA lost elections, UPA 1 came into power and markets didn't know what to do. 17% highest crash on Nifty. And when I came to office, I saw सबके मुंह लटके हुए हैं. Everybody were dead serious. I was wondering, have I joined the wrong industry, इतना fearful था. But then, that was the bottom, and then you saw the classic 2003 to 2007 ka bull rally. One of the biggest bull run of our time, right? Sensex went from 2-3,000 to 21-22,000, okay, in 4-5 years. I missed that. पैसे भी नहीं थे, अकल भी नहीं थी. I missed completely that. 2007-8, I lost huge chunk of money by gambling into stock market, by playing futures and options, by thinking I know market, मैं समझता हूँ, I can ride it well. I paid 50 lakhs as tuition fees. जितनी भी salary थी, सारी savings I lost there.
Oh.
And when you lose this amount of money by gambling or by leveraging, you just don't lose money, you lose everything. You lose your sleep, you lose relationships, you can't focus on your work. Whole day you are just thinking that.
Yeah.
Right? So in hindsight, that was the most stressful time, and I lost everything. 2010, I started putting through SIP, right? So 2010 to 2020, I kept on doing. So this time when market fell, I knew what not to do. I've become wiser. I've read books by Warren Buffett and many others, wherein they always used to say, be fearful when others are greedy. And so this time around, when market gave me opportunity, I went all in. And now in hindsight, all those investments that I made have gone up by 3-4x.
Yeah.
So I've realized people learn from mistakes.
I think your own mistakes are like the biggest.
They're the best teachers.
Yes, absolutely. Yeah. No, yes. And as a passive investor, and in your journey also, you started first doing it yourself, right? I think everyone goes through this ritual that पहले करेंगे, थोड़ा सा हाथ जलाएंगे, and then do the right way. So with respect to that, and talking about buying dips, as a retail investor, right, one way is, I do SIPs.
Yes.
Another way is, maybe I park money, like I just put it, save it, and wait for the right time and then invest when the market is at low.
Correct.
What do you suggest, what strategy?
Very tricky question. Very, very tricky question. I'm sure this question is playing in 90% people's mind.
Yeah.
Let me give you my take on this. Again, I know deep down that this may not again be the best strategy, okay? But I'll give you my view. Anyone can make 12 to 14% return by doing SIPs. Every month you're earning money, you keep on doing that SIP. In the long term, you'll make 12 to 14% return. And now that's not a bad return. That's a very good return.
Absolutely.
If you're able to compound at 12 to 14% for 10 years or 20 years, you are going to create massive wealth. Then how do you make 2 or 3% extra, let's say? So I believe that 80-90% of your monthly SIPs you do through this. 10 or 20%. Keep in liquid. Okay. Whenever there are dips or opportunities in any sector, invest that time. So then you're going to see massive jump, right? Like in COVID, I ended up putting almost 90 lakhs, right? And that has given me 35% CAGR compounding for the last 4 years. So that is one. There is other side of the story also. I have also started to believe that if you have lump sum money today, don't time it. Look at the history of Indian markets for last 40 years. Every 3 out of 4 years, the returns were positive. Only 25% it was negative, right? So you are playing against your odds by staggering it, because every next installment that you are going to do is going to go at the higher level. So if you have lump sum today, the smartest strategy is put in all today and don't touch it for next 10 years. Now most people seeing this podcast may be wondering ki aaj all time high hai. He's saying to put everything today. See, all time high you are seeing today because market is all time high for the last 20 years right now you're seeing. But if you're looking to invest for next 20 years, market today is all time low.
Yes.
It's not all time high.
Yeah.
Because 10 साल में तो यहाँ से double या triple या 4 times होने ही वाला है.
Yeah.
So if you keep on kind of timing, you'll never be able to ride it very optimally. I would like to finally say, whatever gives you peace of mind, do that strategy.
Yeah, the peaceful sleep.
Yes. If you think that, no, I'm not getting this comfort to put all 100 rupees one go, maybe you want to stagger it over 6 months. Logically or rationally, you are doing a wrong move. But if that gives you happiness, so be it.
Yeah.
Secondly, one more thing I'll tell you. Suppose you are staggering your investment, okay? And after 5 days, markets have fallen by 5%. You feel so happy, you're going to put another 50%, right? But believe me, next 2 years, you're not going to even remember that day. So if you didn't remember, which means that fall was never significant.
Yeah.
See, why I remember March 2020, because it was 30-40% fall and I invested almost 86 lakhs. So I will remember for the rest of my life. That was steep. But if it is a 3% fall, nowadays, 2% fall is a crash. Next day morning, it will come bloodbath on the street, right?
True.
So it doesn't make any difference. It's just all in our minds.
Yeah,
right
that
now.
Those little kicks that you get
Absolutely.
probably. Yeah.
And in fact, today, after 15 years, I tell the world that whatever wealth I've created, it was never because of my mind. It was always because of my SIPs.
Yeah.
आज वो 30 lakhs 82,000 लेवल पे भी जा रहा है. I'm not putting my head into it,
Yeah.
तो इसीलिए wealth बन रहा है.
Absolutely.
अगर मुझे आज ही लमसम डालना होता 30 lakh, I would be worried कि I'm putting all money at 82,000 top. कल को ये 10% crash हो जाएगा तो I would have never done. I could have never invested then. But because it is in SIP, I can't do anything. It has to go means it has to go.
Yeah. No, absolutely. I think very fair point. So, I think all convinced that, the control over emotion and, just doing SIPs the right way is the key. Now, for an investor, like a retail investor, I think when I go and open up any portal, there are tens of categories of mutual fund and then subsequently mutual fund schemes as well. So, how do you navigate and what is the right framework or right approach to build a mutual fund portfolio?
Fantastic. Let's take a top view. Broadly, there are 3 categories of mutual funds. One is debt or fixed income. Second is hybrid, which is a mix of equity and debt. And third is pure equity. If you're a first time investor in mutual funds, start with debt funds, which is more like proxy to your bank FDs, savings account. Here, you're not never going to lose your capital. So you'll get 7%, 8%, 6% kind of returns. Try with that out. So at least you understand how mutual fund works. Put in money, after a week, 10 days, pull out money, you will understand. If you want FD plus returns, so FDs give me 7, but can I get 9 or 10? Then there are these hybrid mutual funds. So hybrid is what? Equity plus debt. Hybrid also means equity plus debt plus gold plus silver, like multi-assets.
Okay.
So you can get anywhere from 7-8% to 12-13% return depending on how much equity you mix in that hybrid.
Okay.
The more equities you mix, the more kicker it will give, the more volatile it will become.
Okay.
So equities can range from 10-15% all the way to 70-80-90%, right?
Okay.
So if you want 9-10% kind of return, you may mix maybe 30-40% equities into your debt, and the combination will give you 8-10% return.
Okay.
Even that's a very good return compared to FDs, and that will be much less volatile because of this thing. But the moment you say, no, look, I am not happy with 10%, I want 12-13, then you have no choice but to go in pure equity funds. 100% equity funds, they will be completely volatile and can give you around 12, 13, 14, 15% depending on, again, risk profile within equities, which we'll discuss later. Broadly, you have to decide between debt, hybrid and equities. So debt is generally for 6 months, 1 year, 3 year. Hybrid is for anywhere from 3 to 5, 6 years. When we are talking about equities, I'm talking about 7+ years.
Okay.
The best way to start in equities is generally what we call passive funds or index funds.
Okay.
These are no-brainers. Now, if you're new to equities, just put your money in Nifty 50 index fund, which means your money is going in top 50 companies of the country.
Right.
There is no fund manager who is managing that. It's exactly replicating that index, right? So if index goes up by 15%, your money will also go up by approximately 15%, and so on and so forth. The beauty in index fund is that there is nothing called underperformance or outperformance, because there is no fund manager. You're not competing. You're roughly going to get the Nifty returns, which will allow you to stay for as long as possible, right? So, and the longer you stay, the compounding will happen.
Right.
And for 90% of the investors, index funds are very good. If you don't have an advisor, if you don't have a guidance, and you want to do on your own, just go for any index fund.
Got it.
But if you have an advisor and if you have a little more high risk profile, then again you have plethora of options. You have large cap mutual funds, you have mid caps, and you have small caps.
Yeah.
Right. So in India, the way SEBI defines large cap is top 100 companies by size, by market cap, are called large caps. Between 101 to 250 are mid caps, and anything below 250 is small cap. Right.
Right.
So mid caps will be more volatile than large caps, and will give you maybe 1-2% higher return than large caps over a 10-year period. Small caps will even be far more volatile than mid caps and can give you 1-2% higher returns than mid caps, right? So generally we don't recommend small caps to 90% of the investors, because small caps at times can fall from 100 rupees to 50 rupees also. Okay,
Right.
so
Very volatile.
Very volatile. Unless you are somebody who doesn't look at your portfolio for 5 years and and playing that wealth creation game, you shouldn't be in small caps. So now you have got large cap, mid cap, and small cap. Let's dip in further now. There's a category called flexi cap, which means the fund manager has a discretion to go any cap.
Okay.
Okay, either he can be fully large cap at some time, or he can be fully small cap.
Okay.
As we speak right now, most of the flexi caps are fully large cap or 70% large cap.
Okay.
Maybe they think small caps are expensive and that's why they're in large cap. Or even if the size of the fund becomes huge, they have to be in more of large caps.
Okay.
Because small caps, they will not find opportunities to buy if the fund size is huge. Since last 5 years when this flexi cap category was announced, all the time it has been large cap only.
Okay.
Then it's just replicating your large cap fund, right?
Right.
It's nothing. There's nothing flexi about the flexi cap fund. That is why SEBI, I think 3 years back, came out with a category called multi-cap fund.
Okay.
Wherein SEBI said that 25% of money has to be in all the 3 caps minimum.
Okay.
25% large cap, 25% mid cap, 25% small cap. 25% is discretion to the fund manager कि he can put in large, mid or small depending on what you wish. So I think this is one category which truly reflects the full market. तो अगर आपको पूरा market खरीदना है and you want an active fund, multi-cap is the best choice.
Got
It
it.
happens to be my favorite category also, to advise investors. Personally, most of my money is in small cap fund. It's just a disclaimer I wanted to give, because I can now call myself a professional investor because I've spent 20 years.
Yeah.
I've seen many cycles and I'm okay with volatility. But to most investors on this podcast, we would say that stick to multi-cap kind of funds. Multi-cap also gives you very good returns over a long term, like 14-15% has in the last 20 years it has given. So stick to that. And then you said value funds and contra funds.
There's something called, I think, dividend yield focus. Like they have
So now we are getting to specifics. These are all in equities.
Yeah.
A dividend yield fund will invest in those companies which gives very high dividends, right? So generally the companies which are far more stable companies, they give high dividends. So when you are investing your money in dividend yield fund, you want to invest your portfolio in safer lot of companies, right?
Okay.
Generally we recommend to invest in dividend yield companies when markets are all time high.
Okay.
Or when markets are very expensive. So at least you are buying a safer set of companies. So tomorrow if market falls, these companies will fall much lesser.
Okay.
Then there are funds called contra funds or value funds, right? Certain set of companies that have not performed in the market and they are very cheap. Market is expensive, but these companies are trading very cheap for some company specific reason or industry specific reason. So the fund manager identify those companies and put in. Hopefully that in next 3 years, 5 years, when the story plays out, you will make a lot of returns.
Got it.
One such example I'll give you is when I invested a lot of my money in PSU funds.
Okay.
So PSU from 2010 to 2020 gave negative returns, 10 years.
Oh, okay.
So I said to myself कि 10 साल का negative return है, it can't go this bad, right? And this sector can never become zero. So I started doing my SIP in 2020,
Okay.
and it's
And
been
it
4
would have
years.
shot up.
You know, my 4-year CAGR, CAGR on SIP in PSU fund is 56%.
Wow.
I was putting some 1,50,000 per month. So totally I would have invested around 37 lakh. I started with lesser amount and then 1,50,000. So in 4 years I invested around 37 odd lakh. It became 94 lakhs in 4 years,
Wow.
giving a 56% CAGR.
I think classic example of you took a risk, it gave
I took a
you
risk. Yes.
return.
I mean, I never expected it will give me this outsized returns. It was luck also and many things, because last 1 year, 2 year the returns went through the roof. Now I felt ki boss, this is like peak, you know. I don't think it is really. So I pulled a good amount of my money from that fund and put into another sector which has not performed that great.
Okay.
So when you're putting your money in these kind of contra, timing matters. When to enter, when to exit matters.
Right. So it's being very active,
Very
following
active. And
those sectors.
For most common investors, it's very hard to do. You may get one activity right, but if you don't get the other right, you will negate all the work that you have done.
Yeah, no, absolutely. And that actually brings me to thematic or sectoral funds. Like you were saying, you took a bet on PSU as a sector, right? And, you know, in the recent past, I think a lot of retail investors are now investing into sectoral, and the AUM is going,
Correct.
you know, almost 50% of new investments are into sectoral.
Yeah.
So what is your take on sectoral funds?
No, I'm worried. I'm really worried, because I know this part is not going to end well. Because in the past also it has not ended well. So when a lot of retail investors come into sector funds, actually sector funds are not meant for retail investors. They're meant for very informed investors who understand this risk. Because as I said, in any sector fund, if you have to make huge money, your entry exit both has to be timed well. And a lot of luck also plays a big role. You know, when fund managers themselves have closed the funds now, they're not taking fresh entries. People are buying those stocks in retail. The retail people are buying in their own direct stock portfolios.
Yeah.
So that's a classic sign.
Someone is hearing from someone, and you know the tips are going.
And you know, when the fund manager announces that we are going to close the fund because we can't, huge money come in that time just before they are about to close.
The herd mentality.
The herd mentality.
AUM
Let me get in right
Yeah.
now, you know, before they close the fund. You know why most of the money comes in sector funds, Navda? Because they go onto the website and see last 1 year return.
Yes.
Last 2 year returns, and the last 1 year returns
Recency
shows
bias.
100%. Okay.
Yeah.
So you know what they think? कि last year 100% आया, चलो इस साल 100 नहीं आया, 50 भी आ गया तो अपना काम हो जाएगा. They think in that format. कि okay, 100 may not come, but 50 is not bad.
Yeah.
But boss, forget 50. It can be minus 50.
Absolutely.
Markets can be that brutal.
Yeah.
But that is how, you know, unless you burn your hands, fingers, everything, you will not learn.
No, absolutely. If you are very informed, only then you take those thematic bets where you have to time entry and
even
exit.
if you want to take in thematic bets, I have a suggestion for you. Okay, there is category called business cycle fund.
Okay.
Or they are called thematic fund of funds.
Okay.
Which means the fund manager would invest in 3 or 4 sectors.
Okay.
Which are not performing right now. Okay. So at any point of time in the industry, there would be 3 or 4 sectors which will not be performing.
Okay.
So fund managers will take a contra call and invest your money in those sectors which has not performed well.
Okay.
And when these sectors have performed, some of these sectors, they would rotate money by pulling out from those sectors and putting into another sectors which have not performed. You know, mutual fund have funds wherein the fund manager will put in banking fund, pharma fund, auto sector fund. And if they have realized that banking has performed well, they will put out money from banking fund within that fund of fund, and they'll put in another category or sector fund.
Got it.
Which means I as an investor can remain invested for 10, 15, 20 years without timing it. The fund manager is timing it on behalf of me, and when they are pulling in and out, I'm not paying taxes because it's within the fund.
Right.
So I have started to invest a lot of my money in these fund of funds or business cycle fund, wherein I don't need to time in and time out.
Okay. But on this note, can I ask you like a slightly controversial question? I'm a retail investor, right? As I understand the business cycle fund, and you know, there are multiple sectors or themes here. Isn't it just easy, like I just do index, because index में भी तो उतने ही sectors होंगे?
नहीं. Index में it's a diversified first of all. It would have 10 sectors.
Okay. So
and
it's limited
index
sectors.
Generally rewards the sector that is going up well.
Okay.
The more money chases the sector that is already doing well. In a business cycle fund, fund manager consciously invest into those themes or cycles that have not done well. They are right now out of favor. Right now, as we speak, the fund manager wouldn't be buying defense, wouldn't be buying PSUs or this thing. They would buy
all-time high.
Things that have not worked well.
Got it.
So, and that is what is basic investing: buy low, sell high.
Got it. Understood.
So the contra fund or the business cycle fund are doing that.
Understood. So, Gajendra, so many learnings for our investors across, emotions, portfolio. Coming from your journey, like how your SIP journey has been and what does your portfolio look like right now?
First of all, I want to make a disclaimer that this is not an investment recommendation to our viewers, because Navda, what happens with my money, I'm not answerable to anybody. I can have unlimited patience, I can see unlimited fall and be completely okay about it. So I never give my suggestions or never try to replicate my portfolio to even with my investors also. But because you've asked me, I'll tell you. A good amount of my family money, 35-40% is in multi-cap kind of funds.
Okay.
60% is on the more aggressive side, which means lot more small cap funds, decent amount of mid cap funds, and a huge amount of sector funds.
Okay.
Now, how do I do? So I started with 10,000 SIP. My first SIP, a part of the SIP was in a small cap fund.
This is which year?
This was 2010.
So
5,000 rupees SIP that I did, 8,45,000 is what I put in last 14 years. That is about to touch 50 lakhs.
Wow.
And it has given a compounded return of 23% for the last 14 years.
Wow.
At a point in time in Jan 2018, this fund was giving a return of 32% compounded return. In COVID, this return came to 5% compounded return for 10 years period. And now we are clocking 23%. Of course, small caps are very high right now. That's why you're seeing this. The other thing is, a lot of my money is in sector funds. Somehow I have learned how to time the sector well. I invested a lot of my money in PSU when PSU was not doing well. I invested a lot of my money in auto sector fund in 2020 when the whole world said अब सब work from home हो जाएगा, who are going to buy 4-wheelers, 2-wheelers, or people said अब कोई hotels में नहीं जाने वाले हैं, tourism is the end. These are the best times to put in those stocks or companies or funds when there is complete negative publicity around that sector. In 2019, pharma was going through a rough patch. I ended up putting a lot of my money in pharma. Today I see the same thing trend happening in banking sector. Last 4 years banking has not done well.
Yeah.
I am putting personally a decent amount of my money in banking. मैंने PSU से निकाल के banking में डाला है. So I always play contra. Until last year my SIP was 22 lakh. तो अगर इस साल मैंने 8 लाख और बढ़ाया per month. So I see at this time which is the cheapest sector or opportunity, and that is how I decide my next investment.
Got it.
Personally, अभी मैंने एक lump sum investment 50 lakhs I put in China.
Okay.
Right, because everybody is talking about India story and everything, but the price is already reflecting that also. It's not cheap, but China is dirt cheap. Again, I'm not recommending this to anyone. This is a investment that can play out, that can take 10 years also, and yet also not play out. But again, being a contrarian, I think यार बहुत cheap है, डाल देते हैं, and wait करेंगे 5 साल 10 साल बाद भी अगर आया, I'll make good returns.
Yeah. No, great. I think so many learnings jam-packed. I think we'll wrap up this section of the video. I think our audience has a lot to learn. I'll let them process this. Some great learnings on, the emotional biases in investing, picking the right portfolio, how to start with debt, move to hybrid and then equity. Within equity also start with passive and then move to actives where, then just it's a journey, right? Go sequentially.
Yes.
I think on this note, let's wrap this section. Thank you so much,
Thank
Gajendra.
you.